Chad Watley. I'm with Legendary Capitals. Legendary Capital, just very quickly, we are a hospitality sponsor based in Fargo, North Dakota. We focus on 80 to 200 room limited, select service, and extended stay premium branded hotels located primarily in the heartland of America. At the end of my presentation, I'm going to be very quick to go over the offering. We have a fruit tier and what I believe is a very unique opportunity given that we're closing our fund and liquidating our funds in the next 12 to 18 months. With that being said, I've been in this business over 25 years. I've spent the last 20 years helping advisors, working with advisors like yourself, working with CPAs on tax mitigation strategies. All right, so the reason I tell you all that is you're going to hear some stuff today that is going to be interesting to you. Would you take notes? That's great. Take it home with you. A lot of times you take notes, it gets put on the desk, it gets forgotten about, and you move on about your day because you're all busy doing things and practicing. So what I would encourage you to do, I've got cards up here. Come approach me afterwards, grab a card. We at Legendary offer a CE, 1 hour CE credit presentation for CPAs. And so if you are looking to dangle a carrot to get in front of a CPA and establish a relationship or strengthen an existing relationship, you can utilize me for that. You have other sponsors out there in the exhibit hall, Capital Square, Exchange Right, S2K, others. They can offer similar resources to help you bring value to those relationships with CPAs. So I would encourage you to use us for that. You're going to hear things today that you won't remember. Call us. Take our call or call us. Get us on the phone. There's an advisor in the back of the room here just last week. I got on the phone with them and their CPA and their client. There was a potential 1031 that turned into an OZ deal. I don't currently have an OZ fund or a 1031 fund, but I'm always happy to help ask the right questions, to walk through the process and help you find the right solution for your investors. And most of all the sponsors out there are very willing to do the same thing. So with that being said, there's a disclaimer here. Legendary Capital is not a tax advisor. So this presentation is for informational purposes only today. If you're looking to transact based on this information, please consult your tax advisor first. I am also not a tax advisor, so don't consult me before you make a transaction. Go and consult your CPA or tax advisor. So I looked up this yesterday. In the last 20 years, the S&P 500 is up 345%. In the last 5 years, the S&P 500 is up 117%. So as an advisor, helping your clients look for returns in the market has been pretty easy. As a matter of fact, investors are probably able to do that themselves through index funds, through Schwab and Fidelity and things like that. The types of clients that you're looking for, accredited investor clients, the ones that we all know more of in our book of business, are looking for smart, specialized tax advice. Not only to create returns for them, but to put more money back in their pocket. No one wants to pay more than their fair share of taxes. Is that a fair statement? Mm-hmm. Right? We all want to pay our fair share, right? We want to contribute to the things that we enjoy, but we don't want to pay more than our fair share. And so if you can separate yourself within your existing client base, with the prospects and the advisors that you're competing against in the markets that you live, by offering a combination of smart, market-based investment options that also help mitigate taxes, man, it's going to go a long way to help you not only strengthen those existing relationships, find out if your existing clients have assets somewhere else that you can bring in, but the prospects that you're looking for. And then most importantly, we have any CPAs in the room? No CPAs in the room? Okay. I'm not going to talk bad about CPAs, but they're a difficult bunch. All right, they're tough to connect with. They're historically difficult to try to create a partnership with. But if you can bring value, right, if you can speak their language versus telling them, hey, Mr. CPA, I'm in the investment business. I offer mutual funds, ETFs, stocks. I do all the insurance products. I do all these things for my clients. They're going to gloss over it and not really understand what you're saying. But if you can speak their language, right, if you can talk tax with them, by bringing specific strategies, that's going to strengthen that bond. And I've got some tools here today that can help you do that, and some tools I don't have here today that we can follow up with to help you do that as well. So we're going to talk about capital gains exposure for real estate and sale of business, rising income and future R&D concerns, existing real estate without triggering immediate taxes, and the need for, my favorite, the need for passive and efficient income. Pick-pal investing is kind of a preview. It's an old term. Back when I got into business selling limited partnerships at Wells Real Estate Funds, it's a long time ago. And Boston Capital, anybody remember Boston Capital? Right? You could just buy the losses. You could just buy the depreciation. You can choose which side of the coin you want to be on. That is really coming back into play with a lot of credit investors who've accumulated tons of passive losses on their tax returns. So we'll get into more of that as we get into the presentation, but it can be a really powerful tool for you. So full disclosure, I've told a few people this. About 2-3 months ago, I was approached by Regina to ask me to talk about Roth conversions. I don't have a Roth conversion strategy. Never had a Roth conversion strategy at Legendary Capital. But she knew I had a breakout session, and she knew that there were some other sponsors here. One of the advisors had gone to a due diligence meeting of another sponsor. I think it was Amy. I think it was S2K, and came back and was really excited about this strategy. And so I want to pay a little tribute to that today, and I'm going to give Amy the floor for a few minutes to talk about what they're doing. But very simply, if you have just a traditional IRA, you all know that you can convert that to a Roth if someone's eligible, right? You typically want to do that for a few reasons. One, if the market's down, so the value of the assets are down. If you convert, you pay taxes at that point, but you're doing it on a lower asset base. So your tax liability is going to be lower. That's one reason. And then you get the benefit of having those assets, those market-based assets, grow tax-free over time, and then you exit that Roth IRA, take distributions, completely tax-free. It can be a really cool strategy to use for just regular traditional IRAs. So think about existing clients who have IRAs that are eligible for Roth IRAs. And we've got a lot of volatility in the market these days. Now, the market's backed up the last couple of weeks, but I think it's safe to say we're going to continue to see volatility. So when you see those dips and your clients call you concerned or worried about what's going on in the market, talk to them about this potential strategy if you're eligible. It could be a great way to get their attention and let them know that you're thinking about them and that you're proactive in their financial planning to help them save taxes. Does that make sense? How about a Roth conversion strategy with using private real estate? Now, Amy, you want to take a second and talk about what S2K does in this regard?
Sure. Thank you, Chad. Yeah. We are also a sponsor.
Welcome, join me.
Okay. All right. Hi, everybody. I'm Amy Kelly. I'm the COO for S2K Financial. We're also a sponsor like Legendary Capital in the States, and working with Keek for quite a few years. The offering that he's talking about specifically, we just launched at S2K. It's currently in the review process. So I want to start with that disclaimer within Peak. But essentially, if you look at this chart up here and think about what Chad just spoke about, is when is the right time to convert an IRA, to a Roth? And there's trillions of IRA dollars out there, and what type of strategy should you go into? With real estate development, in the early stages of development, you always see a J curve. And if you're an investor directly into the real estate and you have that equity ownership, then you actually can benefit from that devaluation. But you have to be invested in an entity where they will actually do evaluation. So what our intent on this offering that we've just launched, it's single asset. It's in Charlotte, North Carolina, where the market there is actually booming, not just since the pandemic, but over 150 people a day have been moving to Charlotte since 2000. So not just the last 5 years, and there's a lot more economic drivers there, but you have to be in the early stages of development. So our intent will be at the beginning of 26 is we'll do our first valuation. So if you say, for example, you took $1 million IRA and you invested it in this fund as still as an IRA, and then next year the valuation company, it's a third party valuation company that they specialize in valuations for real estate development, you should expect a valuation maybe 30, 40, maybe even 50% below where you started.
And that's due to rezoning cost, permitting,
Construction, exactly. Thank you for adding that. Yeah, it's just the nature of a development project. And so we'll do the valuation for the first 2 years, which is very typical of all the rock conversion funds that you'll see in the marketplace. Is you'll see two valuations done within the first 2 years, and that gives investors, sometimes those IRA investors will do a partial conversion in the first year because now you owe your tax, right? And if you've got a 30% devaluation, your million's now worth 700,000, then you may want to convert half of it in 2026 and then wait till 2027 to do your second conversion, because you still have to have the dollars from another account that is liquid to pay your taxes on that retirement account. But now all of that appreciation, which we hope that curve continues to go up like this, when the construction and development is complete, is now tax-free because it's a ROC. So that's kind of just the basics of it, and understanding that, you know, the sponsor has some skin in the game is a big component. What we're cautious of, because, you know, we just want to always make sure that the investors are protected, is if you see a markdown, a significant markdown, you know, greater than 60 or 70%, we're cautious of that because you don't want to see an audit. You know, how many of you did conservation easements? Easements were great, you know, until, you know,
We're not.
until they weren't. Now, it doesn't mean that the sponsors were bad, doesn't mean that the deals were bad, but the IRS, you know, they're no different than FINRA, right? They stay in business because of their fees that they collect. So anyway, it's those are the kind of metrics that you just kind of have to look at it. I actually had a printed piece, but FINRA came back with comments on our piece on end of last week, so I had to throw all of my fact sheets in the garbage. But we were able to sort of add an extra disclosure, so I'll have some of my booths shortly.
Okay.
Thanks, Jay.
Thank you.
Just had a real question. When it does go low, so let's say give you $1 million, we say in a year, $1 million, 60%, let's say, and the client only does half. How much time do you think they have until that 60 stays there? Is there a time frame?
It's completely unknown. We don't know.
So
Right.
it's
We'll
really
do
not-
another evaluation there the second year,
Yeah.
which may be another you know, reduction, another 10 or 20%, but we really don't know. That's the crystal ball.
But you guys will know pretty much where you are at what's a good time to kind of switch.
Well, we'll do two valuations here. 26, the beginning of 26, beginning of 27. So you can look at it and speak, you know, I would suggest work with the client and their CPA on this. Always get the CPA.
And how do we change it over to a one-time?
You just do the conversion. Yeah.
Just do new paperwork.
Just convert it.
So he does.
You'll need to do something also with the paperwork. Yeah.
Sure.
There's plenty of that too. Plenty of paperwork.
Yeah.
Typically, do you guys tend to seek about a 40% discount, or?
We're anticipating, you know, 30 to 40%. I mean, certainly it could be more. We'd like to be on the conservative side. If it's lower, great. That's right. That's right.
And that's the key.
Yeah.
Is that bigger point? You don't really need to.
Who's custodian? Depends. Like we've got Union National Bank right now, which is the least expensive for investors. But if you have another custodian you want to work with, and we're just onboarding RBC right now for another firm, we can work through that to get on other platforms for your.
Any other questions? That's good stuff right there. That's a really cool strategy to present to existing clients, as I said. But going to those CPA contexts, those stubborn relationships that don't want to hear about all the things that you do, and taking them a very specific tax mitigation strategy, what's going to help them help their clients. It's going to obviously increase your AUM as a financial advisor. And keep in mind, CPAs charge a fee for their business, right? So they can increase their fee revenue. If a CPA wants to make more money, they do it two ways. One, let me go get a whole bunch of new clients, right? They could do that, but they're probably going to have to add staff and create a lot more work for themselves. But that's okay. They can do that. Or what if they increase their fees to their existing clients by bringing value to that relationship? These are the things that you need to remind them of when you have conversations with your CPA contacts. Let me help you make money and do it so that you're not overworked. Does that make sense? Okay. All right, moving on. 1031 exchanges. I'm not going to spend a lot of time here because I think anyone in the room done a 1031 exchange? I see a lot of hands. Should see a lot of hands. Okay, been around a long time. I'm going to hit a few high points here. Things that you want to remember when you're talking to existing clients, prospects, and CPAs. It's a like-kind exchange. A lot of people confuse the term like-kind. It's simply investment property for investment property. You can exchange an office building for a hotel or an apartment for farmland. You can do that. Like kind simply means investment property for investment property. There's the like kind slide. Go ahead.
You said before that you were talking to a client about 1031 and converted it, and said it went through.
They missed their window. They didn't get a QI, and so they were now left with an OZ.
Yeah, so you took the shot.
But they ultimately decided to pay the taxes. 45 days to ID your real estate, 180 days to close. Everybody understands that for the most part. The big thing I want to leave you with to remind you, to remind your clients and the CPA contacts that you have, is having train those CPAs to ask questions of their existing tax clients. Do you own investment real estate? Before you think about selling that piece of investment real estate, come talk to me, right? When I did a lot of 1031 business years ago, I would get at least 2 calls a week from an advisor or a client saying, I got my check in hand, I'm ready to do my 1031. And then I have to break the bad news to them. They took possession of the proceeds. They did not get that qualified intermediary in place before the closing. If you train them to ask the right questions so that their clients come talk to them before they place that property up for sale, you can miss that whole process. You can miss the whole not getting a QI and put your client in a position to take advantage of the IRS tax law around 1031. Okay? I'm not going to go down this rabbit hole. This is where you want to lean on sponsors like me and Amy and Capital Square and Exchange Right and all the 1031 sponsors out there, is that there are some rules around how much real estate you can ID. It depends on the situation. So I'm not going to go in depth on each one, but these are things that you need to be aware of and your CPAs and clients need to be aware of. Okay? You do need to match your debt and equity. So very simply, if your client or you were selling a property, investment property that has 50% debt on it, the IRS says you have to replace it with 50% or more debt on it. Okay? So that's another important aspect on it when you're having conversations with your CPAs, is to always ask, could they have investment real estate? Yes. Do they have debt on that investment real estate? And then depending on the answer to that question, takes you down a particular path in that conversation.
Chad?
Yes.
So let's say New Deal doesn't have 50% yet. You guys have all the terms with the zeros and stuff.
We don't, I do not have a DST product currently.
Yeah.
I do not have an OZ product currently. I am simply doing this out of the goodness of my heart.
It's pretty nice.
The other thing I want to remind you of is we don't talk about the benefits of DSTs enough. The one particular thing I want to highlight here today is the debt aspect. So if I own a piece of commercial real estate and I'm just a guy that owns a hotel, for example, and I've got 50% debt on it, and I want to, I'm gonna, sell it and exchange into a DST to kick my taxes down the road, right? I get diversification and consolidation. I'm getting some estate planning done, right? But the big thing is that debt that was on that hotel that I am personally guaranteed on my personal balance sheet. The debt on the DST that replaces that is non-recourse debt. I'm not responsible for that debt either. So if you're looking for a way to help your client de-lever their personal balance sheet because they own a lot of real estate debt, having them sell those properties and exchanging it into DSTs helps to de-lever their personal balance sheet. Get rid of that debt off their balance sheet. Get them to live to fight another day. That's another point that I think we should be talking about more in this space. I think it's an opportunity for you and for CPAs to help more clients than they already are. 721 UPREIT. Real quickly, this is something that here at Legendary that we've used a lot of in the last 5 years. We had a lot after COVID, the pandemic. You had a lot of distressed hotel owners, right? Not the hotels themselves were okay, but the owners of the hotels were in a lot of distress. They were overextended. They got forbearance or forgiveness of their debt on their hotels. A lot of them couldn't stay afloat. Well, what we did is the IRS, under our program, it allowed those hotel owners to contribute their hotel into our fund in exchange for ownership in our fund. And in return, they get to kick their capital gains tax down the road, much like a 1031 exchange. So it's a 1031 for a property owner, a hotel owner that's exchanging into a REIT and getting shares in that REIT, essentially, right? It's a little more complicated than that. Our program is a little more complicated than that, but that's essentially what you're doing.
And that owner can exchange it not just for the share, but can they also receive capital or cash proceeds?
They're going to be, in most cases, they're going to be pari passu exactly alongside the common share investors in that fund, and they're going to get distributions. So there's a lot of reasons why they want to do it, right? Diversification, getting out of a property, getting into a portfolio of many properties. The biggest issue we saw in the last 5 years were a lot of hotel owners took forbearance or forgiveness from their banks, right? And if they were to go sell their property, then they're going to have a huge phantom capital gain. And so, think about it in a pandemic, things are recovering, but they sell their property, they get a few $1,000,000 of proceeds out of it. They're going, whew, man, I dodged the bullet. But now they owe the IRS $2, $3, $4 million. So selling the property becomes impossible at that point because they don't have the cash to pay taxes. So what can they do? They can utilize tax code 721, exchange their hotel into our REIT, kick the tax can down the road and deal with it another day. That make sense? Awesome. Got 10 minutes. This is just a quick illustration on $1,000 investment. If you were to do a 721, you pay $50 a unit, and let's say the REIT generates a 5% income stream. You don't pay taxes. Versus the other side, the right-hand side, where if you pay the taxes, you would need to generate the remaining proceeds in an investment that generates a 7.4% return to get back to par, essentially, simply because of the tax burden. It's just math. So nothing earth-shattering or ground-breaking about that particular slide. Let's talk about opportunity zones real quick. Everyone knows what an opportunity zone is. Part of the Jobs Act 2017. We are all really hopeful, right, that Congress will somehow miraculously get their act together here before the summer break and extend the benefits of the current OZ legislation. As it stands today, and this is just, again, I'm not a tax advisor, but if I were sitting in your seats, I would plan on paying my taxes in April of 27. That's the deadline. So if you've already invested or had clients invested in an opportunity zone, or if they're investing today in an opportunity zone, plan to pay their taxes in April of 27. That is the deadline. Another thing I want to encourage you that if you have clients in opportunity zones is that when these were marketed 4 and 5 years ago, 2 or 3 years ago, the sponsors typically have a strategy to refinance the asset, take cash out, and make a distribution. When this was marketed 5 years ago, that's a great plan on paper. We live in a higher rate environment today. We live in a tighter capital markets environment today than we did 5 years ago. So I would go back to your sponsor and I would start asking some really tough questions about what their plan is, come 26, about refinancing their asset. How much do you think they're going to get out of that? And how much in the distribution should we expect? Now, again, your client and you should have a plan, not depending on a sponsor to make a distribution. Have a plan to pay those taxes in April 27. Okay? The benefits: defer, eliminate, offset. We put offset in there because the step-ups have gone away. The deadlines have passed on those. We also hope that in addition to extending the April 27th deadline, that Congress will also bring back those stepped-up bases. There was a 10% and a 15% step-up that have since expired, but those were pretty good benefits, and a lot of people got in those early years of OZ investing simply to take advantage of the stepped-up cost bases. But right now, if whether you're an 80s OZs or ROZ that's closed now or some others out there, in the early years of a renovation of a project, is keep in mind you have to significantly improve the land or an asset. That's the requirement by the IRS. So either you're building something from the ground up and improving the area, or you're taking an existing asset and you're improving it enough to meet the requirement. During those stages, there are losses that are distributed, fund level losses that are distributed out to the investors. Those are passive losses. So if you can find a passive income generator to offset or match up against those losses, that income becomes tax-free. Not tax-deferred, tax-free. So that's another important benefit. I don't think we talk enough about the OZs, is the passive losses they typically generate during the construction or development phase of the projects. Okay? Teach quick timeline, we'll reach through that. What another huge benefit of the OZ legislation were the types of gains that were eligible. This was huge, right? Wasn't just real estate like 1031s. It's stocks and bonds. It's short and long-term capital gains, ETFs. I dealt with an investor last year before our fund closed that delved in cars, antique cars. He sold antique cars. That generated a capital gain.
It's just sales.
That's exactly right. Business sales. And then there's also some caveat on the type of entity that generates the capital gain. So, if it was just in my name or your name, then, we have 180 days to complete that transaction. But if it's in an LLC or a partnership, you actually have a little longer time frame.
It's almost, I might be off by a little bit, probably correct me, but it might be 6 months after your taxes are due.
So you're right. So essentially take the end of the tax year of the entity or the partnership, and it's 180 days from that point.
Yeah.
So if I did it, say, this month, and my partnership tax year ends at the end of this year, I have another 180 days from the end of this year to make the best, to qualify. Good point. Yes, sir.
That carried interest with him.
No.
It's already a sweetheart deal.
Yeah, but if they do away with it, I heard that last cycle, but no.
Yeah, or a venture fund or private equity, right?
Because that's tax capital gain.
If it's
Yeah, Cup State thing we're doing away to carry. It's like
it's a good question. I'm not tax.
Let's talk more about time.
Yeah, let's talk more about tax, right? I'm gonna breeze through this because I want to get to passive income, passive loss, because I've got 4 minutes here. There are different types of income paid by the IRS: wages, salaries, portfolio level income, and then there's passive income. Passive income are going to be things generated from partnerships, activities that you're not necessarily involved with. But somebody gave me an example of like Coca-Cola, and Coca-Cola pays a dividend. Well, isn't that passive income? I'm not at Coca-Cola every day mixing the syrup, right? I'm not doing all that. No, that's considered portfolio level income. It must be categorized as passive income that shows up on tax form 8582. And that's the kicker, guys. When you're talking to your clients, or you're talking to their CPAs, we're going to harp on this a lot. Make sure you make those connections with your best client CPAs. That's real easy for them to do. Ask them, do you have any clients that generate tax form 8582? You don't have to get into explaining passive income, passive loss, or what it is you're trying to do. Just ask a very simple question. Do you have any clients that generate tax form 8582? If they do, and CPAs have the ability to run a sort on their software of every client that generates this tax form. Now, it's going to pull a list. Typically 10% of every CPA's book of business has clients that have passive losses. Okay? So not all of them are going to be eligible. Not all of them are going to be accredited. Some passive losses could be 5,000, 10,000. So it's not enough to really worry about. But it's a starting point to start directing and talking to your CPA about how you can help their clients who are generating consistent passive losses. The other thing about passive losses is they carry forward indefinitely unless you use them. So we've seen tax returns that go back 10 years. These passive losses carry forward. CPAs are not wired to be proactive, to find active strategies to deal with it. And so they just carry it forward every year when they report the taxes. Yes, sir.
Unfortunately, if those passive losses die with you, and they don't transfer to a spouse.
Unfortunately, that's correct. That's how you get rid of them. You sell the asset or you die. Preferably, you just sell the asset. Dying is not a cool option. But, yeah.
Inevitability.
So, again, it is an inevitability. Like death and death.
Well, you pay religion.
Just your fair share of taxes. Death and your fair share of taxes. Great. There we go. Just a quick commercial for Legendary Capital. This is just some math on, hey, what is the optimal investment in something that's generating a 7.5% passive income at a 37% tax break, or a 37% tax bracket, the calculation of the type of tax equivalent yield. So let's just say you have a 7.5% return, passive income vehicle. You're able to match all that up against someone who has passive losses and they're in the 37% tax bracket. The return is almost 12%. You got a 12, you take a 7.5% return, it turns into almost a 12% return. And you're helping them get rid of passive losses off their tax return. Very powerful tool. All right. I'm going to take 2 minutes, please. I'm ahead of my time here. I'm going to take 2 minutes and talk about legendary capital. Okay? We've got really, yep, 2 minutes, please. Thank you. Please. We've got 2 investment opportunities that I am very passionate about here, and it's approved at peak. One is our short-term bond fund. We have a 1-year option here and a 2-year option. The 1-year option, at the base rate, the coupon is 7%, paid on a monthly basis. The 2-year option at a base rate of $10,000, the coupon is 9%. These are for clients looking for a short-term income solution. If you have clients that are nervous about the market, they're nervous about the volatility, they're nervous about the tariff, they're nervous about Congress, they're just nervous, right? Great place to put money away for a year or 2 while the market settles down and they're going to earn an above average return while they do it. I don't know how much longer these rates are going to be where they are today. If the Fed enacts any more rate cuts, or if we see some movement in the 5 and 10 year, we may end up lowering these rates, but for now, these are very competitive rates. Okay? This is the one that I'm most excited about. So we have a real estate investment trust. That's our flagship fund. It's at $110 million. We have 17 hotels. We started buying properties before the pandemic. Most of our properties have been purchased post-pandemic vis-a-vis our UPREIT strategy that I talked about earlier. Well, we are able to bring in, just so you know, almost $150 million of hotel assets is what came into our fund during our UPREIT strategy. We invested $17 million of equity into that $150 million of hotels. So think about if we'd have bought those traditionally, like you got a hotel that's $10 million, we'd have gone out and raised $5 million in investor equity and then borrowed $5 million, right? So we have $5 million at risk. If we'd have bought $150 million traditionally, we would have had to raise $75 million of investor equity at risk. We only put $17 million at risk. So the types of returns that can potentially generate, the equity that those transactions created at the time we purchased it, totaling an aggregate total of 3.13. So for every dollar of equity invested, it created $3.13 of equity on our balance sheet. So now we're giving people the option to buy into this REIT. It's currently priced at $10.57. You can go in as a limited partner, no income. No income for 18 months. But you can buy this. Let me say that again. It's valued at $10.57 by an independent outside firm, Kroll, which used to be Duff & Phelps. You can buy this as a limited partner with no income. You're not eligible for any income, but you can buy it at $7.93. Last year, we told our investors that our intention is to liquidate in the next 12 to 18 months. So at some point, we're going to be closing this fund and we're looking to liquidate. One last thing and I'm done, Brian, I promise. Okay? On here, we have 2 Charlotte hotels that created a 4.89%. So that's the equity created, 4.89 multiple. That's what was created at the time of purchase. These 2 properties are under contract. The closing date is May 15th. We're selling them for $22.5 million, about $16 million of debt on it. So that's what, $6 million of equity. We put $1.2 million of equity into those 2 hotels, and we're getting 6 out of it. So now this UPREIT, this strategy that on paper looked really good, we now have a field test that shows us that we can create those kind of returns simply by using the UPREIT strategy. So I would encourage you to talk to me more at the booth about the opportunity to get into this investment before it closes and take advantage of the pricing. And then if you have clients that have short-term income, let's talk about the bond offering. And then we do have a preferred passive income strategy that's under approval or under review at peak that can help you with those clients who have suspended passive losses. Now I'm done. Thank you very much for your time.